I think there are 5 things that are really wrong with the British economy which underpin the need for a really radical change. The first is that the proportion of GDP we spend on investment is pitifully low. The international average is about 26%. We spend less than 16% on all types of investment, but worse than that, on the type of investment that really produces increases in output per hour, which is quite a narrow range. It's mechanisation, it's technology, and it's power. We spend pitifully low amounts, less now than 3%. And by the time we take off depreciation, there's nothing left. And if you really want to know why productivity is static, I don't think it's because of lack of competition or too much regulation, favoured by the right, or that it's not implementing an industrial strategy, which is the left solution to this. It's because investment is so low. So that's the first big problem. The second is that we've deindustrialized to a point where we simply cannot pay our way in the world and trade. And because we've deindustrialized, we've also lost the fact that industry is a much more prolific provider of increases in output per hour than services are, that there's much better jobs, and critically, it's what we export is much more goods than it is services, and it's light industry particularly that produces the goods for that. The third is we've got a huge balance of payments problem, now running at something like 6% of GDP, which we finance by selling off assets and borrowing money from abroad in a way which is completely unsustainable. Partly as a result of that, we've got another problem, which is that we're running out debts all over the place, both as a nation and through our government as individuals, and we simply cannot go on running up debts at this rate because it's in the end unsustainable. You cannot have a balance of payments deficit of 6% of GDP living 6% beyond the income that you're earning forever. And finally, what you then finish up with is very low rates of economic growth, driven by consumer demand, by quantitative easing, by asset realization, and not by investment and trade, which it should be. And the result of all this is massive discontent, because if you've got no productivity increases, you can't really have any wage increases, and we've had no real wage increases for the bulk of the population for the last 10 years. And looking ahead, I think there's a real risk that we're not going to have any wage increases in real terms for most people for another 10 years. And I want to come back in a second to what the implication of that would be. Now, I think the case for devaluation really rests on the fact that the reason why we're not investing where we need to is because it's simply unprofitable at the moment to do this. And because it's unprofitable, it isn't happening. And the only way you're ever going to get investment to take place is to make it pay. And this is something I must say I would have thought that would appeal to the IEA as much as anybody else. It has to be a market-driven solution to this problem if it's going to work. And if you look at the figures, what is really critical is at what point does it become worthwhile citing factories in the UK to make manufactured goods rather than in China or in Germany. And at the moment, what's happened is because it's so uneconomical here, we've deindustrialized over the last 20 or 30 years, even as late as 1980, about 30% of our GDP came from manufacturing. Now it's less than 10%. And what is crucially important is to get that reindustrialization to take place. Now, if you can do that, you can then begin to solve a whole lot of other problems. First of all, if you get industrialization taking place, a higher proportion of GDP coming from manufacturing, you begin to solve your trade balance problem and get back to a stage where we're not borrowing money from the rest of the world all the time. You can get a higher rate of increase in productivity as a result of shifting resources into manufacturing. You then won't have the same process of running out debts that we've got at the moment, and you can get growth running probably at something like 3% or 4% per annum. And only on that basis is it possible to shift resources into higher amounts of investment as a percentage of GDP at the same time as raising real wages at the same time. And if you look at the model of the economy and how this would work, that's what you would be able to achieve. Now, would this actually work? I mean, the standard objections are about we produce more inflation, retaliation and so on. These are relatively easy to deal with. The really crucial issues to make this work are two. One is, would the economy respond sufficiently vigorously to make all this work? Would you have a burst of export that you wouldn't otherwise have had to rebalance the balance of payments? The second is, can you make this pay by getting enough of a return out of the investments that you make in mechanisation, technology and power to be able to finance a real change in emphasis in the UK economy towards a much higher rate of economic growth? And if you look at the econometric figures, and I've got loads and loads of them that I've prepared over the years, this shows that it would be possible. And if it is possible, I think we ought to do it. Now, what I'd like to do in conclusion is to say this. If you're going to run a successful economy, you have to have the consent of most people to the way it's run. There is a real danger in this country now that there are going to be more and more people who are increasingly discontented because of the fact that they're stuck with wages that aren't increasing. And there's a risk then that what's going to happen is that there'll be a drift, which we've already seen, towards Trump in America, to some extent towards Brexit in the UK, towards UKIP, towards protest movements of all sorts, a retreat from the open markets that you support so strongly, a drift towards protectionism, and an erosion of the ideas which you think are the most important of all. And what I would say to you is that if you cannot run the economy in a way which produces reasonable standards of living and increases in those to finance both consumption and reasonable public services, if you can't do that, you will lose the support of the electorate, and you will find the very values and ideals which you support so strongly being eroded away. So there's a very crucial requirement, I think, for there to be a readjustment in the way we run the economy, which does produce a higher rate of economic growth, which increases the consensus in the country, which reduces the enormous imbalances that we've got between London and the rest of the country, which gives the rest of the country a way of earning its living in a way which hasn't got at the moment. And the only way you're ever really going to do this is by making manufacturing profitable again to trigger off everything else. And that's why we need a lower exchange rate.
Sorry, John, I didn't put that slide up. I'm not sure when you're going to speak to it, but I think that illustrates your point very well about the overvaluation of the pound. Do you want to comment?
Yes, I think it's actually worth us commenting on this. This is what's happened over the last 40 years. This is where we were in the late 1970s. Then what happened was monetarism came in because Keynesianism didn't work in terms of controlling inflation. And what happened then was that there was policies put into effect, particularly high rates of interest and increasing the money supply. But the effect of all this was massively to increase the exchange rate. It then stayed roughly level here, dropped a bit in 1992 when we came out of the ERM, stayed roughly stable there, and then we started selling off assets on an incredible scale. What happened in 1999 was that the Monopolies and Mergers Commission was abolished. This was replaced by the Competition Commission, which had no public interest test for taking over British companies, allowed the British economy to become the sort of hunting ground internationally for companies all over the place. We sold our rail franchises, we sold our airports, we sold our ports, we sold a massive swathe of manufacturing industry, loads of property, and this pushed the exchange rate right up here. At the same time, what happened in China was that they came into the economy in about 1980 and devalued very substantially and moved into the market economy using their resources much more efficiently. And this is what opened up this huge gap between the East and the West. And this is why the East has really scooped so much of the manufacturing capacity in the world, whereas the West has deindustrialized. So the problems I'm talking about aren't really ones just to do with the UK. They're to do with most of the rest of the Western world. But again, what will happen is that if the Chinese economy romps ahead the way it is at the moment, whereas we do it as badly as we are, then what you will find is that the ideas behind the Chinese economy, the autocracy they run there, the reluctance to embrace open markets in the way you would like, I think are going to finish up by being very damaging. So what we need to do is to close that gap, get the pound down to somewhere around here so we can compete with China, and that must be the way ahead if we're going to have a reasonable degree of prosperity in the UK. So there's a huge amount at stake here. Leave it to you.
Thank you. Well, thank you, John. I think that's a very compelling story, which I think will find a lot of wider support. So I feel slightly embarrassed standing up here being about to disagree with it. I think John has made a number of arguments. If you like, there's some series of links in the chain. So there's the weakness of real incomes or real wages, the role that low productivity has played in that, the role that low investment has played in our poor productivity performance, the importance that John places on manufacturing, and finally the argument that policymakers should engineer a significant fall in the value of the pound to correct those imbalances and weaknesses in the economy. As it happens though, I think each of those links in the chain is weaker than the one that went before, and the argument for actively devaluing the pound is the weakest of all. If I start though with the diagnosis of the economic problems facing the UK at the moment, I don't actually think we're in quite as bad a state as many people suggest. John, for example, has talked about the risk of permanently stagnant living standards for most people. In fact, if you look at the data, the only indicator that is still significantly weaker now than it was before the crisis is the measure of real average earnings that you'll doubtless hear a lot about. But that's an outlier, and also I suggest it's a fairly flawed measure. For example, because it's an average, it doesn't take account of some quite important compositional shifts in the labour force over the last 10 years or so. So, for example, there are a lot of older people who are typically higher paid, who've moved out of employment because they're retired. And there's also a lot of lower skilled people who are typically lower paid, who've moved back into employment because the UK economy has created so many jobs. So the net effect of that has been to depress the average wage, but actually most people over that period are better off. There's an alternative measure which looks at what's happened to wages of people in continuous employment, and they're essentially people who've had the same job for 12 months or more, and they typically have seen nominal wage increases of 4% or more over this period, which is still a fairly healthy increase in real terms. So when people say things like Britain hasn't had a pay rise since the recession, I don't think that's strictly true. And there are other measures of economic well-being where things are now better than they were before the pre-crisis period. So things like real disposable incomes per head or consumer spending per head, those measures are all better now than they were. They're still not great, but I think the big picture is a bit better than some people would suggest. Of course, looking forward, there are now lots of pessimistic forecasts about this period of weakness being extended over the next 5 or 10 years or beyond. Crucially, they're dependent on the OBR's new view on productivity. So, you know, the Independent Office of Budget Responsibility has, like most forecasters, been too optimistic about the pace of productivity recovery over the last 10 years or so, and recently they finally decided to chuck in the towel. But frankly, their new forecasts are little more than guesswork. You know, they've been wrong in the past. I suspect they're wrong now, but whereas previously they've been too optimistic, now they're too pessimistic. Of course, there are a lot of possible explanations for our poor productivity performance. You may have heard a lot about austerity, for example. A new favourite is the idea of cyber slacking. We're spending so long, you know, tweeting about events and following things on Facebook and so on. We're not actually doing any proper work. I personally favour 2 other explanations. One is that there's a mismeasurement problem. You know, we're very bad at measuring productivity in things like services, where most of the growth has been. But also that a lot of the weakness in productivity has simply been cyclical. We've had a period where there's been a big fall in unemployment. It's been easy for companies to create value, to increase output by taking on more relatively low-paid workers. But as the labour market continues to tighten, they're going to have to focus on boosting productivity again. There'll be more incentive to invest in capital without the government having to do anything more. It is true, as John says, that the UK invests a relatively low proportion of GDP, but that's nothing new. It certainly doesn't explain the weakness in productivity over the last 10 years or so. and arguably it's consistent with an economy that's largely driven by services than by manufacturing. So this is where the significance of manufacturing comes in. And here I think I do differ with John, or start to differ. It is true that in the past, manufacturing has been the main source of productivity gains, particularly things like heavy industry. But I'd like to challenge whether that's going to be the case in the future. As technological advances roll out into other sectors, we'll see lots of improvements in things like AI and blockchain and driverless cars and so on that will boost productivity in sectors that we don't traditionally consider to be manufacturing or heavy industries. I'm also wary of the link between the decline in manufacturing and productivity and the link that he then draws with regional inequality. I see no reason, for example, why the rest of the UK outside London can't benefit from services-led growth, why it just has to benefit from manufacturing growth. I think that was the model in the past. It doesn't have to be the model in the future. I'm also pretty sanguine about the existence of a very large current account deficit. Again, I think there are lots of measurement problems there. It's worth noting particularly a lot of the deterioration recently has been not in trade in goods, it's been on the income account, which is something that's very hard for statisticians to measure properly. Also, if I'm right that real incomes are set to recover, then there'll be more scope for households to save more than they have been. And if fiscal discipline is maintained, then the government should start saving a bit more as well. And that will help to correct the balance of payments problems without the need for the currency to fall further. So this brings me to the crucial issue of the exchange rate. And as you know, John's central argument is that a substantial devaluation of the currency is required to restore competitiveness. Now, for starters, from a free market perspective, I've got two problems with this. First is that I would say that the level of the exchange rate is essentially a price like any other, and the government shouldn't be intervening in setting the exchange rate any more than it should be setting any other price. Now, I know that some would counter that exchange rates can deviate from fundamental value for long periods of time, so there might be a potential market failure here. But just because the market isn't perfect doesn't necessarily mean that the government is going to be any better at deciding what the appropriate level of the currency would be. As it happens, also I would say the currency has fallen a long way. Here's an alternative chart to the one that John presented earlier. I'm afraid there's always a problem with economists. Economists can always come up with two pieces of data, allegedly measuring the same thing, but telling two very completely different stories. So this is also a measure of the real effective exchange rate. It's the trade-weighted value of the currency. So it takes the value of the pound against our major trading partners and weights them according to how much trade we do with them. It's a real exchange rate, so it adjusts for inflation. I think there are a couple of differences from the chart that John showed. One is that this is deflated using consumer prices rather than unit labour costs, and there are arguments on both sides. It's also a narrow index, so it's only showing the movement in sterling against our major trading partners over this period. If you were to look, for example, again about what happened to the pound against the dollar, it would look quite similar to this chart. But the essential point from this chart is that we've already had a pretty substantial devaluation, or set of devaluations, over the last 20, 30, 40 years, and yet our economic performance hasn't been transformed. The other problem I've got from a free market perspective is that devaluing the currency is arguably a zero-sum game. I mean, it might be good for the UK economy, and British politicians might like it, but arguably it only succeeds by making other countries worse off. I think for this to be a policy that we would support, it needs to be correcting some sort of asymmetry in the global economy. Now, perhaps there is one. I mean, John hinted at the imbalances between the West and the East. So Asia saving a large amount, running huge current account surpluses, that's sucking demand out of the global economy. But if that is the problem, then that's an argument for devaluing all Western currencies against, for example, the renminbi, rather than specifically sterling on its own. But let's suppose that the British government did want to engineer a weaker pound. First of all, how is it going to do that? Now, there's a fundamental problem here that we have signed up as a member of the G7 to a commitment not to devalue the currency for competitive purposes. So there's a statement here from the G7 in May. It's also in the documents that you have in front of you, so you don't necessarily need to read it. But the short point is that the UK, as a member of the G7, has said it's not going to use currencies as a means of gaining competitive advantage. Now, we could try and persuade the rest of the G7 to abandon this statement, or we could leave the G7. We could add it to a list of things we want to leave along with the EU. But realistically, if we are going to devalue the currency, we have to do so by means other than simply intervening in the foreign exchange markets to drive the currency down. There are a few things we could do here. For example, we could keep interest rates lower for longer than we would otherwise have done. We could engage in additional quantitative easing. But if we are doing that, we do need to change the inflation targeting mandate of the Bank of England. Or we need to ramp up other means of controlling inflation, for example, macroprudential measures. In other words, intervening more in setting the price and quantity of credit, which is something that I feel uncomfortable about as a free market economist. There are other things that we could do to weaken the pound. We can make the UK a less attractive place to invest. We could impose all sorts of restrictions on foreign ownership of British companies. We could restrict the right of foreign investors to buy into the London property market and so on. Many people have advocated these, but again, from a free market perspective, that's not something I feel comfortable with. But then even suppose that the UK can get the nominal exchange rate down. The question then is what happens to the real exchange rate? And I know John would agree with this, that an exchange rate devaluation only works if it isn't eroded by a subsequent pickup in inflation. Now, to be fair, there are good examples of where a devaluation of the currency has worked and boosted the real economy. When sterling was kicked out of the ERM or voluntarily chose to leave, in 1992, inflation picked up a little, but a lot less than most people expected, and the economy clearly recovered. But arguably that was a special case because there was a huge amount of slack in the economy. The economy was stuck in a deep recession. The exchange rate was fundamentally overvalued and interest rates were being kept high to support it at that level. Those are not the circumstances we're in now, and the exchange rate has already fallen the wrong way. The economy is operating close to full capacity, close to full employment, and interest rates are already very low. So I don't think that's a trick that we can pull off now. So in conclusion, I would be concerned that a policy of actively weakening the exchange rate, even if we could do it given the political constraints, would actually worsen many of the problems that John identifies. I think it would be inflationary, so it would exacerbate the squeeze on real incomes. As it happens, it might also increase wealth inequality because a weaker exchange rate would tend to push up asset prices, which is great if you've got an asset, not so good if you haven't. And I think also a weaker exchange rate would actually reduce the competitive pressure on companies to get their act together. I mean, Germany, for example, has done very well with a strong exchange rate because that provided the discipline necessary for German industry to get its act together. So if we are talking about free market solutions to Britain's problems, I'd rather focus on things that involve the government doing less. So that's the standard IEA talk about things like cuts in tax rates and deregulation of the economy, getting rid of the things that do stifle innovation and investment, rather than what I think would be a policy of manipulating currencies and therefore adding the exchange rate to the long list of prices that the government is trying to control in the economy. So with great regret, I don't think John has the solution to Britain's economic problems.
Well, let me respond to some of that. I think the first question is about whether we really have got a big problem or not. Now, I think we have a very large problem with a number of multiple facets. First of all, it's absolutely true that there are some ways in which you can mitigate the implications about the lack of wage increases, but the fact is that the average or the median wage over the last 10 years has not gone up at all, and it seems to me to be extremely unlikely it will go up for the coming period. Even if you have a growth rate of 1.3% or 1.5%, which is the projection at the moment, by the time you take out the increase in population, which is running at about 0.7%, and the fact that with the big balance of payments deficit every year, you're sucking demand out of the pool of available funds for paying wages, and if you notice that The proportion of GDP going to wages and salaries is going down all the time, and all these other factors. The reality is that with a growth rate of 1.3% per annum, you are not going to get any real wage increases as far ahead as we can see. And this seems to me to be a really serious problem. It also seems to me to be a really serious problem that at the moment we've got a balance of payments deficit which is about 6% or very close to 6% of GDP. And you cannot go on expecting the rest of the world to subsidise our standard of living to this enormous extent year after year after year. Sooner or later, something is going to have to give. And it does seem to me sensible in those circumstances to try and anticipate what's going to go wrong and to try and do something to guide the economy in a way which is going to avoid a crash coming sooner or later, which I think it will. And then there's the broader issue which I referred to earlier on, about the fact that if you know, there's a huge amount of discontent in this country about the way the country is run. There's a great crisis of confidence in the political leadership of this country right across the political spectrum. This is not a party political point. There's a feeling of alienation that the rest of the country feels for London. London has an enormous balance of payments surplus if you just take London on its own. But if the rest of the country's got a deficit of 115 billion or whatever it is, and then you add on to that the surplus that London's making to equal up the figures, the rest of the country must be running at a balance of payments deficit of, I don't know, 130, 150 billion pounds a year. And the fact is that most of the cities and regions of this country simply haven't got enough to sell to the rest of the world to pay their way. So I think it's really not good enough to just say that there are difficulties about all this and what we've got to do is just rely on market forces to sort it all out, because very patently this is not what's been happening. And you know, the idea that what's been occurring over the last 40 years is that all the prices of the exchange rate has just been driven by market forces and nothing else can't possibly be right. If we can get that graph back that we had earlier on, I don't know if you can do that.
Sorry,
you've got your this here. Do you know how to work this?
mine or yours?
Well,
That's mine.
Well, that's your graph. Now, interestingly, this graph, as I think Julian will confirm, is largely between the pound and the dollar.
Well, it's the major exchange rate, so it wouldn't, for example, include the renminbi.
No, it wouldn't. I mean, I think the real problem, as I was saying earlier on, is not that just there's a British problem, although I think we've got a particularly acute version of all this. The problem is that the whole of the Western world, particularly the United States and the United Kingdom, but also quite a lot of the European Union and elsewhere, are all uncompetitive with the Far East. And they're the ones who are romping ahead because they've industrialized, because they've got a huge rate of investment. I mean, I can tell you that the Chinese invest about 15% of their GDP every year in the areas of the economy which generate these huge increases: mechanization, technology, and power. That's how they managed to achieve these enormous growth rates of 10% or something. So I really don't think it's good enough to just brush the problems on one side. And I think, as I said earlier on, the real long-term danger to the IEA is that in the end, the very ideas that you depend on and which you think are so important, which where I largely agree, of avoiding protectionism and all this kind of thing, are in danger of getting swept away. You can't get the economy to work better for most people. And I think that is the really crucial test at the end of the day. You need some sort of synthesis between the success that Keynes produced during the 1950s and 60s and the discipline that was introduced by monetarism and neoliberalism after that, so that in the end you finish up with a reasonable growth rate combined with moderate rates of inflation. And that's the golden, this is really where we've got to be if we're going to be successful over the coming period. And the trouble is, I don't think honestly what Julian said is going to produce that environment.